What's up, everyone? I have a super important video today for you guys on ETFs. We're going to go over what they are and what to be careful of when you're trading them and investing in them long term. So a lot of people use ETFs and they're very successful in doing so, but they have a certain way of going about using ETFs to make money. And there's certain types of ETFs, and some are for trading, some are for investing, some are short term, some are long term, and you need to know which ones you're going to be trading and which ones you're going to be investing in order to make money in the long run. So first of all, guys, what an ETF is it just stands for Exchange Traded Fund. And that just means it tracks an underlying asset or group of stocks, and it just reflects the stock price. So instead of having to buy the entire S&P 500, which would cost you over $30,000, the ETF SPY gives you the option to purchase equity in the S&P 500 for about $300. So this is very enticing to people who want to invest in the S&P 500 and diversify their portfolio without having to buy $30,000 worth of stock. Maybe you're buying weekly and you don't have $30,000 a week to invest. Maybe you're just going to buy a share weekly of SPY, and that's only $300. So ETFs are a great way to diversify where you're putting your money if you want to invest in a certain sector or a certain group of companies, but can't necessarily afford to buy a mixed bag of all of the literal shares of every single company. So there are ETFs like the SPY, which tracks the S&P 500 index. There's ETFs like JNUG that track gold miner companies. There are ETFs like UGAZ that track natural gas companies. The list goes on and on. Pretty much any group of companies that you can think of, there's an ETF to correspond to it. So ETFs can either be used by traders for short-term gains or people that are looking to put their money to use long-term investors. So there's certain types of ETFs that traders shouldn't touch and that investors shouldn't touch. So there's ETFs that are leveraged and ETFs that are not leveraged. So an ETF that is not leveraged just directly tracks an underlying asset like gold companies, like the S&P 500, and it correlates directly to the price of the ETF. So long-term, percentage-wise, you're getting the exact same percentage return over any period of time with the ETF as you are with the underlying set of stocks. That brings us to leveraged ETFs. So leveraged ETFs are a little bit better performers of the underlying asset. So the ETF of the S&P 500 is SPY, and that is not leveraged, but SPXL is 3 times leveraged of the S&P 500. So that means every time S&P 500 gains 1%, SPXL gains 3%. And every time the S&P 500 loses 1%, SPXL, the leveraged ETF, loses 3%. So why does this matter? As a trader, you're going to want to maximize your intraday swings so that you can look for the greatest potential for profit. So it doesn't make sense to trade something that's not leveraged when there is another ETF over here sitting that is leveraged. If you're only getting in and out of the position in the same day, you're able to use 1/3 of your buying power on something that's 3 times as leveraged as you would have to use with a single leveraged non-weighted ETF. That is, $300 worth of SPY would yield you the same profit or loss as $100 of SPXL would. So as a trader, we're looking for the SPXL positions to put less of our money to work to make the same amount of profit. That being said, as an investor, we want to stay away from leveraged ETFs. Why? Because leveraged ETFs lose massive value over time due to something called leverage decay. Take, for example, I have $100 in my bank account. Don't even worry about ETFs right now. I have $100 in my bank account. I gain 3% on the $100, goes up to $103. I then lose 3% on that $100. I now have $99.91. Take a minute, do the math. Yes, it's correct. But I've lost 9 cents out of my $100 just by going up 3% and back down 3%. The percentages up and down aren't any different from each other, 3% up, 3% down, but I've lost 9 cents on my $100. The process of that happening over and over and over just sucks value out of those ETFs long term. And as you can see, if you look at JNUG long term, if you look at UGAZ, DGAZ long term, these are all leveraged ETFs that lose massive value over time because of that effect of leverage decay. The same percent being added and subtracted in multiples, sucking value out of the ETFs one day at a time. So while sure, they might have good days where it would have been a good idea to invest in them, long term, they're going to lose value. This doesn't happen with non-leveraged ETFs because it tracks the group of stocks directly. It's directly based on the movement of those stocks. The 3 times leveraged ETFs is a 3 times multiplier of those stocks. So when it's exaggerated in the upwards direction and exaggerated in the downwards direction, that effect takes some money out of the stock because the same percentage of a higher number is a higher number on the way down. That makes sense. Take this, for example, guys. If you invested, I got to do some math real quick. If you invested $25,000 in UGAS 5 years ago today, take a minute, take a guess. Which of these numbers do you think would be your final balance of your account? Bingo, $7. You had $7 left if you invested $25,000 in UGAS and just let it sit. That's because UGAS is a 3 times long natural gas ETN linked to natural gas. That's a 99.97% drop in your value of money over a 5-year period. Not a good investment. Same thing with JNUG, guys. If you were to invest $2,000 in JNUG 5 years ago, you'd have $97 left. That's a 95.44% decline in your money over the course of 5 years. Not something that we want to be investing in. However, if we move over to the SPY, which is a non-leveraged ETF, we look at the past 5 years, there's a 43.59% increase because it's directly tracking the S&P 500. So the bottom line, guys, here is that if you are an investor, you're looking at non-leveraged ETFs to invest your money in long term. Obviously, you have to make good decisions about those ETFs in order to get a return, but you're not going to fall into the trap of a decaying ETF. If you're a trader, you want to look at the leveraged ETFs because that's going to allow you to use less money, less of your buying power to afford those positions and get the same payoff or profit or loss as you would with a much larger amount of money in the non-leveraged ETFs. So there's 2 types of ETFs that we need to be able to distinguish between. How do you tell if something's leveraged or not leveraged? Just look at the name. If anywhere in the name is a 3x or a 2x, or I think some are even 4x, if they have that in the name, it means it's a leveraged ETF. So crude oil, 4x bull ETF, that is a leveraged ETF. JNUG, 2x or 3x multiplier bull of the gold miners, that's a leveraged ETF. SPY, SPDR, S&P 500 ETF, no multiplier in there. Not leveraged ETF, just a regular ETF. DIA, SPDR, Dow Jones Industrial Average ETF. No multiplier in there, non-leveraged ETF. So a lot of people that are traders will be trading options for SPY and SPXL. You really can get away with trading options for either weighted or non-weighted. It doesn't really make a difference. Especially if you are a short-term trader, it's not really going to make much of a difference. But if you're trading long out options on something that's extremely leveraged, just beware that if that ETF crashes, it's going to take a lot more to bring it back to break even than it would with a non-weighted ETF.